Hi, everybody, and welcome back to our first video in Chapter 19, where we'll be looking at variable costing and analysis. In this chapter, we'll describe how absorption costing can result in overproduction. And I hate to admit it, but this is exactly what can and I have seen does happen in the real business world. We're going to take a look at how we can use, though, the contribution margin ratio different from the gross profit margin ratio for decision making. And then in Appendix 19 Alpha here, we're going to try to convert that income under variable costing to absorption costing, which I think you'll give you a much better appreciation of what we're dealing with in this chapter. So what we're going to do is compute unit costs under both absorption and variable costing. And then we'll prepare and take a look at and analyze the income statement using both absorption costing and variable costing. And lastly, we'll try to determine a product selling price and special order pricing based on contribution margin. Okay, let's get started. Here, we're going to compute the unit cost under both absorption and variable costing. So we have two product costing methods. You're familiar with the absorption costing. I'll jump ahead a little bit to this one. And that costing includes direct materials, direct labor, and both variable and fixed overhead. Whereas variable costing, we're going to do that a little bit differently. We're going to treat fixed overhead as a period cost and basically expense it in the current period, as opposed to having it run through the cost of goods sold. So variable costing then includes direct materials, direct labor, but only variable overhead. Okay. I should point out, though, that variable costing is not permitted under generally accepted accounting principles for external reporting purposes, but it can result in misleading product cost information and poor managerial decisions. Interesting dilemma here. All right, let's look at that in a little more depth here. Our product cost under absorption costing includes, as I mentioned, the fixed cost. Variable, direct, and material and direct labor are all included in product costs under absorption costing, but fixed cost is shown as a period cost below the gross profit line. Okay, let's take a look at that. Here, in this example, we have direct materials at $4 per unit, direct labor at $8 per unit. We're going to make 60,000 units, and our variable overhead is $3 per unit. Fixed overhead is 600,000 per year. Okay. So if I take my, under absorption costing here, if I take my $4 per unit, my $8 per unit, and my $3 per unit variable costs, we put those in both our absorption costing product cost and our variable costing. However, this $10 fixed overhead cost, that's going to go into our product costing under absorption costing. And if we walk that through a little further, you'll see that we only expense that, if you want to call it that when we actually sell the products, and we debit cost of goods sold and credit finished goods inventory. Whereas if it's a period cost, it's going to be expensed in the current period, which may or may not be the same period in which the cost of goods sold would have been sold. So If I look at this for the moment, fairly easy to understand here. We have this $10 of fixed cost. How did we get it? We took 600,000 of fixed overhead divided by the 60,000 units of production. Now, that $10 does not appear in the variable costing column because we're going to expense that in the current period. Important. All right. So let's look at an income statement using absorption costing and using variable costing. So here, our same example, except that we have $40 of selling price per unit. And now, if I look at this, we are producing 60,000, 60,000, 60,000, but the units that we sell are going to be different. Not in year one, they're the same. But in year two, I'm producing more than I sell. That gives me, that means I'll have 20,000 in ending inventory going into year three. But in year three, I sell more than I produce by 20,000 units. So my ending inventory is back to zero. Okay, everybody good with that? All right. Now, one thing I will point out, notice here that selling and administrative expenses do have a variable and fixed component to that. Now, that's not important for absorption costing, but it will be for variable costing. So let's take a look at that. Here, the units that we produce are going to be equal to the units that we sold. Very important to know that. So here's our production of skates, and here's our sales of skates, pairs of skates. Now, income under absorption costing and variable costing are going to be the same in year one. Let's see why. Under absorption costing, I'm going to sell 2.4 million. That's 60,000 units times $40. And as you can see, they're the same under both absorption costing and variable costing. Variable expenses, though, are different. Well, let's go through absorption costing first. We'll take the cost of goods sold and multiply it times that $25 per unit that we got back here. Now, what we're going to do is multiply that through by the number of units that we produced. We produced 60,000 units at $25. And our gross profit then is going to be 900,000. We back out selling and administrative. We had 200,000 of fixed costs plus $2 of variable cost per unit times the 60,000 units. That comes up to 320,000. Subtracted from 900,000 gives me 580,000. Now, under a variable costing statement, this has some subtleties to it, so be sure to pay attention. We have the same sales. Our variable cost per unit is $15. That $10 of fixed cost per unit is not included there. And that gives us the variable cost of goods sold of 900,000. And our variable selling and administrative is 60,000 units times the $2 of variable cost. So together, that means we have 1,020,000 of variable expenses. We call that the contribution margin. And that contribution margin, if you can see through my picture there, is 1,380,000. It is not gross profit. Gross profit is absorption costing only. Contribution margin is variable costing. So now below the contribution margin line is our fixed costs, only fixed costs. I have fixed overhead of $600,000 and fixed selling and administrative of $200,000, totaling $800,000, and that leaves me nicely with $580,000, same as full absorption costing. Okay. So now we're going to produce more than we sell. And in this case, you can see that our income, let's go back, our income under full absorption costing was 580,000. Now here, we're going to take we're going to sell only 40,000 units. So that's 1.6 million, same as variable costing. And we take that, what we sell, which is 40,000 units times $25 per unit, gives me $1 million here. Gross profit 600,000. We do the same calculation here for selling and administrative expenses, and our income is 320,000. But under variable costing, we go through that same calculation methodology we used, and we only make 120,000. You will see that that's $200,000 difference in net income, or income before tax, however you want to interpret that. Big difference, right? We're producing more than we sell. And why is that? I'm going to tell you. We'll talk about that later in this chapter, but I'm going to tell you why that is. And the reason is we haven't sold 20,000 units that we produced. We produced 40,000 units, but I should say, we sold 40,000 units, but we made 60,000 units. That 20,000 units is in ending inventory. It's not been sold yet. So as a consequence, that $10 of fixed costs per unit times that 20,000 units gives me 200,000 that has not yet been expensed in full absorption costing here. And that's why we have a difference. We'll go into that a little more at the end of this chapter, but I wanted you to have at least a feeling for that as we go forward. Okay, now it's just going to be the opposite. Here, we produce less than we sell. So in this case, we're going to sell 80,000. The cost of goods sold is going to be 80,000. Part of that's from ending inventory, and part of that's from current manufacturing. And we'll have gross profit of 1.2 million, less our selling and administrative, but we had a few more units here for variable selling and administrative. And that gives me $840,000. 200,000 less than our variable costing. That's because this month we are actually selling that 20,000 units from the that we overproduced in the second year. So here in year 3, we finally expense that, and that 200,000 hits the income statement through cost of goods sold and causes that difference of 200,000 here. Anyway, that seems like a good place to stop this video. And when we return, we'll take a look at summarizing these results. Until then, bye for now.